Today we're going to look at a case study of a couple in their mid-50s who are currently preparing for retirement. Now you'll see that their income is very healthy, they have a decent amount of assets, but when they look at where they're at today, they feel like they haven't saved enough for retirement. Now, they have made some bad moves over the years that were not their fault, specifically with a bad life insurance policy. They were sold some annuities that just are not performing, and they said, at the time of purchase, we didn't really understand what we were getting. But how do we fix what we have so we don't have stress during retirement? So we're going to go over exactly what we did for them, and what you'll see is that we were able to guarantee them enough income in retirement, and they can also leave a legacy to their children. So let's start off by talking about where they're currently at. So we've got a husband and wife in their mid-50s. Jill is 54, Bob is 52, and their gross household income is $450,000. That consists of the husband's W-2 job. He works at a tech company, and then they also have several rental properties that produce income. But that's the gross, because some of their rental income is servicing the debt that they have. When we look at their assets, they're healthy. So they've got about $400,000 in cash. They have some old annuities valued at about $275,000. They have an IUL policy with a cash value of $85,000. A 401k at the husband's current employer of $200,000, some stocks at $220,000, a real estate portfolio, which includes their primary home, of $3.4 million. So their total assets are about $4.6 million. When we look at the debt, it's primarily mortgages. So they've got two mortgages, one on their primary home and one on a rental property. So their total liabilities are $930,000. So for their early to mid 50s, they've got a net worth of more than $3.6 million. So they feel good about that. What they really like is the real estate, particularly with the income that it's producing, where the goal, specifically over the next 10 years, that a lot of real estate investors have, is to use that to pay off real estate debt that they've got, and then use that real estate income for income in retirement, because it's no longer going toward debt. So what do? Well, the first thing we looked at here were life insurance policies. That's what they were interested in. So step one that we looked at is they wanted to use some of that excess cash they had on hand of the $400,000 and move it into a life insurance policy because they like the benefits of the cash value. The cash value is a safe place to grow our money. We can access it anytime we'd like without any penalties, and it's also tax-free, provided we follow IRS rules. Now the thing about them though, they wanted to fund their policies with a lump sum and then never pay another penny into it. I'm going to go through the exact numbers of what they did. The growth rate that they were interested in is somewhere between 4 to 5%, which is the net, not the dividend rate, but the true net rate, and then they've got the tax benefits as well. So in examining the policies, they saw that they're better off putting the money there than just leaving it in the bank, and they'll also have life insurance, which is important to them. Now, the companies we considered are as follows. We looked at Mass Mutual, Guardian, and then also Penn Mutual, and they decided on Mass Mutual and Guardian. The husband went with Mass Mutual. The funding we looked at was a total of $100,000, so $50,000 in the first year and $50,000 in the second year. And then we also looked to 1035 exchange the IUL with about $85,000 in cash value because it has not been performing when we looked at it. Then we've got Jill, who went with a Guardian policy, who decided to fund $100,000 per year for the first and second year, a total of $200K. So we've got $100 going into Bob's policy and $200 total going into Jill's policy. Quick correction, Bob actually ended up paying $55,000 per year for 2 years, so a total of $110,000. So let's look at these policies, shall we? First, we'll look at the actual ledgers from the insurance companies, and then we'll look at it on Excel just to simplify things. So here is Bob's policy. We mentioned that he's 52. You'll see 53 for his age on the illustration, and the reason why is because this is showing his age at the end of the first year. Whenever you get a life insurance policy, see if the age says age at end of each year or age at beginning of each year. Different insurance companies do things differently. But what we've got here are two deposits of $55,000. Why we have more in the first year is because that's the 1035 exchange. So the estimate that I had on the whiteboard was $85,000. It ended up being about $82,000 that was actually rolled over. And by the way, with a 1035 exchange, I'm not a fan of just jumping into that. We'll always review what the individual currently has first and see what things look like moving forward. A big mistake with life insurance sales is I look at a policy, it's not performing to my liking, and a 1035 exchange is immediately proposed as a solution. Where if you can make adjustments with what you already have and correct that, you can often make that existing policy better because it's based on your age at the time you purchased it, so there's lower expenses. Now in his particular case, that old policy with an was an IUL, and just the performance there was not attractive. The wife expressed multiple times she wasn't happy with it. We looked at it, looked at options, and it made sense to transfer. So that is a tax-free transfer of cash value from one policy to another. So that's why we see more going into the policy in the first year. And when we look at the total input, how much is going in here? A little bit less than 200,000. If you add those up, that would be 187, 192. Okay. So you got 192,000 going in. Look at your cash value. He's positive by year 3. So a 1035 exchange is a great way to accelerate the cash value growth in a policy. And then after the second year, his out-of-pocket is 0 forever. He did not want to pay anything in after that. Then we've got the wife's policy. So she went with Guardian. Here we go. We're going to look at the guarantees as well. So she funds $100K for 2 years. Her minimum premium is up here. So that's the base premium. We also have the cost of the term insurance rider. What that means is her true minimum are those two together, so call it 10 grand per year. But it's set up where she's only billed for that, and then she can add up to 100K per year. Because she's got that money in the bank, she's quite certain she wants to move in here, but at the same time, if an opportunity comes up with real estate, she doesn't want to be on the hook to write a check for 100 grand. So we make it very flexible in that respect. So when we look at this guy, you've got the worst case scenario on the left, the current scenario based on the current dividend rate in the middle, and then a middle of the road scenario on the far right. Let's just look at the left, then the middle. There's your two payments, 100 and 100. Nothing goes in thereafter. We can scroll down a bit, but what you'll see is the cash value will continue to appreciate even based on the guarantees, which are always good to look at if you want a worst case scenario. And then you've got the current dividend, which in tracking Guardian policies for years, we've seen them deliver along with MassMutual. Break-even point, just about. Policy year 4, she's paid in 200, she's got 199, 798. But that's still quite attractive. She might add more money, but we wanted to set the plans up where she was not on the hook to do that. Okay, so let's take a look at these on Excel very briefly, which is the same thing we just looked at. So first, we've got the husband's policy. There's your 1035 exchange. There's the true minimum, so that's the base premium plus the term rider cost. There's money going toward PUAs. There's your annual outlay, the total outlay of what he's actually paying in, $55,000. So when you add these two up, red and purple, it gives his net out of pocket of blue. Cash value, there's your money column, there's your death benefit. What jumps out at you here, if anything? First year cash value is negative. That's the biggest drawback to any whole life insurance policy. So why that's negative is because we have an input of 137 and we have 128. The next year, it's positive because I was at 128. I added 55. I got my 55 back plus another $2,000. That's why it's the $185,000 figure. I'm getting what I paid in back plus more on top of it. And then I pay 0 in, and it continues to grow over time. Now, what we do in cases like this is after the 7th policy year, we'll drop the death benefit. After the first 7 years, we can drop the death benefit, which reduces costs and allows the cash value to grow at a faster pace. You can actually see that if you look at your cash value growth. So it's increasing every year. And then look at that. Like year 6 to 7, the increase year over year goes up by about $300. Then when we reduce the death benefit, check this out, the increase jumps by $2,000. So reducing the death benefit will reduce costs, which allows your cash value to grow at a faster pace. These were all important steps that they wanted to be aware of. The wife's an engineer, so a lot of attention to detail. But they wanted to be aware of this, especially since they do not intend to fund these policies for a long time. That's not what they want to do. So that's his policy. We've got the same thing with her policy, just no 1035 exchange. You'll see the death benefit reduction there as well. Same thing with the cash value growth. And those are their whole life insurance policies. So where this is going to come into play during retirement is they've got this safe asset on the back burner that's just going to continue to grow, and they can access that cash value on a tax-free basis if they want to. That's the big attraction point to the life insurance policy specifically. They might use the cash value to pay down some of those mortgages. We talked about that a little bit, but what they really like is the idea that that's there in retirement that they can use to supplement income, but it's secure. It goes nowhere but up, no market fluctuation or anything like that. All right, let's progress on to step 2. So this has to do with annuities that they already had. They purchased annuities back in 2016, and they weren't performing when we looked at them. I'm going to go over exactly what they had. We'll look at the initial deposit, but they didn't look good. But like the life insurance policy, when we talked about the IUL, if we see that it doesn't look good on the surface, it does not mean just abandon ship. No, examine the product. How has it actually performed? Call the insurance company to see what your guaranteed income looks like down the road. A big problem that happens so much is people are often told about one bad feature of a product that they purchased years ago, and they think, oh, I was ripped off. A lot of times an agent might lead them to believe that. But the problem is then they transfer to something new, and then years later they find out this new thing is not as good as the old thing I used to have, but everything was not clearly explained to me. You ever have something like that happen? It's never a good feeling. So we reviewed what they have first. Let's go over exactly that. So Bob's annuity, when he purchased it back in 2016, he purchased it with an old IRA. At the time, it was just under $70,000. Jill's IRA back in 2016 was about $144,000. Now, over the past 10 years, these were 10-year annuities, we see that they have appreciated, where Bob's has grown to $88,000 and Jill's has grown to about $188,000. Is that good from a return standpoint? Let's take a look. So in speaking with Jill, she said, when we purchased these annuities, we didn't really understand them fully. Someone came to our house, we met at our kitchen table, and we said, hey, looks like a good idea. They guarantee some income down the road, and they can perform nicely as well. That's what happens to most people, honestly. Let's look at what they were sold. So this is what they have, actually, but here's what I want to do. This is Bob's. And what's nice about statements is we can see how much was deposited and then what our value is. They're at the end of the surrender period, 10 years, so the cash surrender value and accumulated value is just about the same, minus up $130. But paid in about 70, has 88. If we look at his wife's or Jill's, there you go. There's the 144 deposit. There's your cash value of 187 and change. The accumulated value, just about 188. So what's the actual return? Well, I'll show you how you can calculate that. You can do this with a compound interest calculator on Google. You can easily Google search this. I'm going to use one in Excel because I built it and I have fun with this kind of stuff because I know I'm strange. So let's look at the husband. IRA transfer, 69,557. We want to hit what in the target amount? Let's go back to it. 88,239. Do you know what that would come out to? Well, if you just punch in 2%, that's the first thing you can do. You're at 84. So you're quite close when you look at it. Came out, I believe it was about 2.41%. There you go, $88,000 and change. So over the past 10 years, the average growth rate was 2.41%. So let's look at Jill's policy. What did she earn? Well, the return came out to about 2.7%. I think it was 2.71 to be precise. But if we just plug in a 2.7% interest rate over the next 10 years, there's the 187.5. And if we go back to her statement to see exactly what she has right now, 10 years later, there it is, 187.5. That was challenging because they moved money from an IRA in 2016. What would have happened if they just left it there in the market? It probably would have grown by more than 2.7%. Now, when this happened, it's not because annuities are just bad, like life insurance. If a life insurance policy is not set up correctly, the cash value is going to be horrible. The same exact thing can happen with annuities. We've got to make sure that they are sold properly and we know exactly why we're getting them. Here's why theirs didn't perform. They had an income rider attached. When you attach an income rider, there is going to be an annual fee associated with the policy, and the annual fee is deducted from the account value. That's going to drag on the return. Also, what I've seen is when you attach those income riders, it does limit the earning potential, meaning typically when I look at an annuity that does not have an income rider attached, not only do I not have a fee, but typically I see higher cap rates and the companies keep them higher. That's not true of all annuities, but I do see that happen a lot. But with that said, if we look at their annuities, their guaranteed income at age 65, we got this by calling the company. The client actually did because the insurance company would release the information to them. Bob was about $48.20 and Jill was $10,664, which means she's 54 now. If she keeps what she currently has, at age 65, she's guaranteed $10,664 for the rest of her life. That's the income guarantee. Could be a little bit higher if the annuity performs. The hard part is it hasn't performed thus far. That's where she struggles with it. So, is there a solution? Yes. We look to transfer them to new annuities. For Bob, his current value of $88,000 and change, we looked at moving that to a new annuity. The new annuity is set up to guarantee income. The income guarantee that we see up front from the company is a little bit less than $14,000 per year, compared to what he's currently guaranteed, $48,000 and change. If we look at Jill's new annuity, the income guarantee is $26,500 per year. Now, these are annuities that are specifically set up for income. So what this means, going back to the income rider and the fee, there is a fee associated with these annuities. The purpose is not to grow the account balance. The purpose is to receive guaranteed income in the future. When we look at their assets, they are quite liquid. They've got money in other retirement accounts, stocks. The life insurance is liquid, so they have that. The purpose of this, again, is to produce income down the road. So when we look at the combined income that they'll receive, if they kept doing what they already were doing with the annuity, it'd be guaranteed at $15,500. The new ones, it's guaranteed at $40,000 and change, just by transferring it over to a new annuity. And the timing worked out well because they had just ended the 10-year surrender period, so you can easily do that. If you have an annuity and you're within the first 7 to 10 years and you've got that surrender period, that's where it's hard. So let's go over their annuities. I'll show you something cool here. What we've got, husband on the left, wife to the right. Here's the $88,000 transfer for him today. At 65 is the target date for income. You see the $13,000 and change figure. What do all of these other numbers represent? Well, up here at 60, if he said, hey, I want to retire early, well, what this annuity can do for him is he can elect to take income early. It'll be $10,000 in change per year. What the income chart displays is the age you elect to flip the income switch on. That is then the guaranteed income you will receive every year for the rest of your life. It's an income guarantee, which is nice. We looked at the same thing with the wife. There you go. At age 65, $26,000 in change. 65 is when they're thinking they're going to want to do this. So here we go. So year 0 is up top. You've got the husband, year 0, 52. The wife, year 0, 55. And then the combined income. That's what I'm talking about. So today, they deposit $275. 10 years from now, Jill flips her income switch on. And then a few years later, when Bob's 65, he flips his income switch on. It's nice to have 2 annuities like this because I can flip one on now, and then if I need more income later, I can flip that on then. If he says, hey, we're good, I'm going to flip it on when I'm 70, the income's going to be even more, which is pretty cool. So we've got the total annual income. It's about $40,000 per year combined. And what the total income shows, see that box? What that represents is when they received payments greater than the $275 that they moved into these annuities. So they get their money back pretty quickly, which is cool. And with annuities, it does depend how long we live. If Bob makes it till 90, total income, $1.1 million. And you pay $275. See what's going on with the guaranteed income? Don't have to think about it, peace of mind product. That's exactly what they were interested in. So let's summarize everything here. This is how they have prepared for retirement. Now, what we did not talk about much is their real estate income, and we didn't talk about their Social Security income at all. So their real estate income is around $150. That's likely going to go up as they account for inflation and they raise the rents as necessary and such. And the plan is to have those mortgages paid down, hopefully paid off by retirement, since they can use a lot of that rental income from the real estate to attack the mortgages right now. But once those are paid off, now that's free cash flow. So they'll have that. Social Security, when they plan to take it, the combined between both of them is around $60,000 annually. The annuities guarantee $40K per year. So you've got total income at $250. They live on $450 now. However, the majority of that is servicing the debt. So that amount is something they are comfortable with. And again, that does not account for any rent increases with the real estate they own. But here's the big thing. Whenever we look at guaranteed income, what I'm not comfortable with is just saying, here's your guaranteed income and you have no backup assets. The reason why is because everything tends to cost more every day. So what they have on the back burner is a lot. They've got the real estate, so they will have equity in that. If they decide to sell a property, that'll result in a large liquidity event. They've got a 401k. The purpose of that is to grow it and eventually use that to supplement income. Even if they don't want to, they'll have to, whether they cash it out or if they just hold it. RMDs are going to kick in at some point, but that's going to be used to produce income. They've got stocks. That's really a long-term buy and hold. They want to see how those perform. Then they've got the cash value. That's the opposite of the stocks when it comes to the safety. So they're well diversified there. They still have money in cash, which is always good, but we're not associating any type of growth rate with that. But when we look at this, particularly the 401 stocks and cash value, this can be used to supplement income as needed. And you've got different buckets you can access here from a taxation standpoint. If there's years where their real estate perhaps is not paid off and they're in a lower tax bracket, those would probably be the years to look to pull money from the 401k, because everything you pull out, you're taxed on 100% of that. If I'm in a high tax bracket and I need more income, that's where the cash value is attractive, because I can pull it out tax-free. See what's going on here? Where you've got different assets and you can leverage them. And then at the very bottom, they can leave a legacy. If we go back to the life insurance illustrations, where we started, what does this look like? Well, here's the husband's policy. At 90, this assumes he doesn't touch it. His death benefit, 1.178, so call it 1.2. The wife's annuity at 90, the wife's life insurance policy at 90, $800,000 in change. So combined, they're very close to about $2 million in life insurance proceeds, which are paid income tax-free, which is very nice. So overall, this is how we currently have helped them prepare for retirement, but things will change over time, and we'll look to pull different levers and see where we can continue to help them as the years pass. Hope you enjoyed this video. I would love to know your thoughts. Please feel free to leave a comment below, or you could DM me directly, whether it's on LinkedIn, Facebook, whatever it might be. And as always, I hope this helps. Thanks so much.